Hello dear algorithms traders. Worldwide more than 5 million traders try their luck in trading every day. What most people don't even know is that with their approach, they have no realistic chance of ever breaking even. So most of them die a slow loss death and lose a lot of money in the process. In today's post, I'm going to show you what's the best way to break even. You've probably heard of the triple 90 myth. What is meant by this is that 90% of all traders have lost 90% of their deposit after 90 days. However, this is not as dramatic as it is claimed. Of course, in the long term, 90% of all traders lose, but as a rule, these are slow, creeping losses. Before a trader starts trading, he first analyzes what he can earn in trading. With 0.01 lot and a TP of 10 pip, the profit is €1. With 0.05 lots at €5, with 0.1 lots at €10, €50 are earned. With 0.5 lots and between 1 and 2 lots, €100 to €200. That looks good at first glance, but you also have to compare the losses. With a stop of 5 lots, the losses are between €50 and €100. So the trader is now trying to find a good value for money between profit and loss. With 0.5 lots you can win €50 and lose a maximum of €25. Now the trader starts to calculate. Complete 4 trades daily, 3 winners of €50 each are €150. Losing once with €25 makes a total of €125. The whole time 25 trading days brings a monthly profit of €3,125. That's a nice plan that doesn't work for a beginner. The background to this has something to do with volatility in Eurist. To do this, I carried out a very complex evaluation in the M1. 1,000 trading days and 1.5 million candles were analyzed for this. I not only filtered the volatility by individual days, but also by different hours. As the average ATR is 1.5 pip over the last 4 years, one could trade within this average ATR from 10 a.m. to 9 p.m. With an ATR of 2 pip you can reach your goals a little faster, but then the trading times are a little more restricted. A part-time trader who comes home around 4 or 5 p.m. can usually only trade for 2 to 3 hours with an increased ATR. And now this table gets interesting, where we can see exactly after what time how many pips are reached on average. In 1 minute an average of 1.5 pips is reached. The pip value per minute is 1.5 and the risk factor is 1.0. When the candle reaches 3 pips per minute, the risk factor reduces to 0.5. After 10 minutes, an average of 6.2 pips is reached. The pip value per minute here is 0.62, and at the same time the risk increases by a factor of 2.4, since the average ATR is 1.5. As we know, our example trader's target is a TP of 10 pips. However, these 10 pips are only reached after 28 minutes, and if we add the spread to that, it even takes 30 minutes. The risk is even 4 times higher in 30 minutes. We also note that the trader only has about 2 hours where there is increased volatility. And now we recalculate again. 30 minutes per trade means 4 opportunities to enter in 2 hours. However, not every opportunity can always be used, since the indicators are often not clear. This is exactly why only 1 to 2 trades are realistically feasible. 1 trade per day, of course they are all only winners, results in a total additional income of €750 per month. The reality is different. The trader deposits €3,000 with the broker, trades with 0.5 lots and a leverage of 200. The initial realistic profit rate is 30%, the spread is 0.5 and the stop is 5.7 pips. TP close to 10 pips and 1 trade is made per day. At 1%, the risk is within a healthy range. In the first year, the trader made a loss of €1,427, and here again in the overview. In the second year, there are only €1,573 left, and the winnings increase by as much as 2%, but the risk doubles. In the second year, this results in a loss of €1,141. Losses have diminished, so things seem to be slowly picking up. Unfortunately, there are only €400 left in the account, so another €3,000 will be added. The win ratio now even increases to 34% and the total loss goes down to €856 at the end of the third year. The trader now thinks he is close to breaking even, so the number of lots is increased. Unfortunately, stress reduces the win rate to 32%, resulting in a loss of €2,283. The trader needs to add another €3,000 and wants his money back as soon as possible, so he increases the number of lots to 1.5. Even this time, the win rate goes up by 4%, yet at the end of the fifth year, there is a loss of €1,712. In the next year, the win rate even increases to 38%, but the risk is disproportionately high. Despite this, the loss at the end of the year is 3 times smaller than in the first year. Now it comes to an unpleasant conversation with his wife. She tells him, "You've been trading for 6 years now, you don't have time for me and the kids, and you've already lost €8,000 out of the €20,000 we saved for our house." He argues, "Honey, I'm getting better every year and I'm on the verge of a breakthrough." Okay, she gives in, 1 more year, then it's over. Shoots another €3,000 after increasing the number of lots to 2 because he is about to break through, but unfortunately, he cannot cope with the stress and the win rate falls back to 36%. This results in another loss of €2,290. Lost €10,000 in 7 years. If he doesn't stop now, his wife will probably pack her bags. A great secret of success lies in my developed pip value per minute. If we graph the risk with the pip values, we see that over time the risk in trading increases. After 1 hour, the risk becomes relatively smaller again. And now let's take a closer look at the short-term realm. We see that from 1 to 3 minutes the risk area becomes even smaller, up to 10 minutes the risk is moderate, after that it increases more. Incidentally, that is exactly the reason why I am usually in the trade for between 1 and 3 minutes and leave the trade after 10 minutes at the latest. 3 minutes of trading time per trade means 40 opportunities to enter in 2 hours. However, since you cannot use all the opportunities, only 10 to 20 trades are realistic. Now let's see how we can get there more easily with this information. First of all, as a beginner, we only need to deposit a maximum of €1,000 capital and trade with 0.01 lot. The win rate is 30%, stop 1.5 and TP 3.5 pip. However, 1,000 trades are not completed in 1 year, but in 3 months, that's 15 trades a day. This results in a loss of €37 within 3 months. The risk per trade is only 0.02%. €963 is still available in the second quarter. The win rate now increases by only 1% to a total of 31%, and this results in a loss of €33. This results in a loss of €125 in the first year, €66 in the second year and €11 in the third year. If all goes well, that's a total loss of €200. At the end of the third year, the break-even point would have been reached, and €798 are now left. Now in the fourth year we increase the number of lots to 0.25, the win rate increases to 45% and 4,000 trades are made per year. The risk is therefore 0.63%. These factors result in a profit of €1,841 in the fourth year, which is now carried over to the next year. We increase the number of lots to 0.5, this now results in a profit of €7,363. The win is now carried over into its sixth year, resulting in another win of 14,721 at 0.75 lots. In the seventh year we trade with 1 lot and the total profit after 7 years is €51,000. Of course, you can also reach the goals faster, that always depends on the risk a trader is willing to take. Now we are still missing some important basics that are crucial. First let's look at the 3-minute trader, the 9-minute trader, the 27-minute trader and the 81-minute trader. Incidentally, all 4 professionals work with the same real win rate. Likewise, they trade the same amount of time, trade 200 days a year and trade 81 minutes a day. But they can also sit in front of the screen for 8 hours. Since everyone has been trading for a different amount of time, Trader A can make significantly more trades than Trader D. There are some differences every year. Although all traders have been trading for the same amount of time and work with the same real profit rate, they naturally achieve different profits, which we will now take a closer look at. Trader A makes 4 times more profits than Trader D. This is due to the efficiency in trading. Of course, the pips will increase over time provided you are on the right side, but at the same time, the pip value per minute will decrease. This means the longer you are in the trade, the more inefficient the profit per minute becomes. Of course, Trader A loses more than Trader D, but since they are all operating at the same win rate, the ratio is exactly the same. Trader A has the lowest ratio of profit to net payout. This is primarily due to the trader tax, since losses over €20,000 cannot be deducted in the same year. The return is up to 4 times higher for Trader A and the risk is even up to 6 times lower. The expected value fluctuates between €12 and €74. Since 70% of price movements take place within an equilibrium, an expected value of €12 is significantly better than €70 in order to achieve effective profits. The real profit rate is the same as the hourly wage for all 4 traders, but up to 4 times higher. Dramatic thing, however, is that time limits the number of trades. Now let's assume hypothetically that it takes a trader 10,000 trades to break even. It would then take Trader A 2 years, Trader B 5 years, Trade C 16 years and Trader D 50 years. This means Trader C and D would have no chance of reaching their break-even point within a reasonable time. Now let's imagine that after 10,000 trades Trader A does not lose €200, but even a loss of €1,000. Under the given circumstances, Trader B would come up with €2,200, Trader C with €3,400 and Trader D with €5,900. And that's only because they have larger stop zones. And why would a trader trade decades longer to break even and at the same time lose up to 6 times more? With the approach I've outlined, most traders die a slow death and never break even. Traders achieve the greatest learning effect by entering and exiting. By observing an open trade for hours, the learning effect is very small. Only the trader who has enough experience can be successful. This experience is only possible through a high number of trades. It is important to trade with the smallest possible contract sizes in order to keep losses as low as possible. I wish you a nice weekend and lots of success next week in retail. Best regards, Michael.